When investing in ETFs, we can easily find out dozens of quality funds online. Given that most ETFs consist of hundreds of stocks, it is a good idea to have several on hand that cover different sectors of the market without repetition. In this video, I will introduce 3 best ETFs that you can invest for the long term without stress. We will also analyze the investment strategies, assess risks, and see how much you can earn from $100,000. At the end, we will build a portfolio using these 3 ETFs to maximize returns and minimize risks. Before talking about ETFs, let's see what are the criteria in selecting these funds. First, investments should be diversified to reduce risk. It is always a good idea not to put all eggs into one basket. Second, low management fees. We want this charge to be as low as possible. Third, the ETFs we buy should align with our investment goals. Lastly, we need to see if the ETF has a good track record in growth. This shows the potential of profitability in owning this ETF in the future. Now that we know what our investment objectives are, let's discuss the first ETF, Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This is a passively managed ETF launched and managed by Charles Schwab. The investment aims to offer investors 103 quality dividend stocks in the U.S. market, tracking the performance of the Dow Jones U.S. Dividend 100 Index. The current assets under management is $56 billion, which makes it one of the largest ETFs. Stocks in the fund are in the large cap value segment, so each of them have over $10 billion in market cap. These large cap companies are usually very stable, have good cash flows, and are less volatile than other stocks. A lot of them in this portfolio are well-established companies that have been in the business for decades or longer, which gives investors peace of mind. SCHD implements a very strict selection process to pick the best stocks for dividend payment based on the solid track records. The holdings are based on the following criteria: a minimum of 10 consecutive years of dividend payments, the minimum float adjusted market cap of $500 million, and the minimum 3-month average daily volume traded is at $2 million. The qualifiers will be entered in another round of selection process. This time, companies will be ranked by cash on hand compared to debt, profit compared to the investment, dividend yield, and the past 5-year dividend growth rate. With such a comprehensive selection process, SCHD includes companies with great performance that ensures consistent dividend payouts in the future. The 103 dividend stocks in SCHD are mainly in financials, healthcare, consumer defensive, industrial, and energy. These are the sectors that pay good dividends for decades. In the foreseeable future, these sectors are expected to continuously increase dividends and provide stability to the investors. Some of the great companies in the top 10 holdings are AbbVie, Coca-Cola, Chevron, UPS, and Verizon. Warren Buffett loves to purchase stocks in these fields. As we can see from here, SCHD's investment strategy aims for the long-term growth and dividend payouts. Additionally, SCHD's expense ratio is 0.06%. This is a $6 management fee for every $10,000 you invest. The management team makes it affordable for investors. So investing in SCHD saves us valuable time picking individual stocks and reduces risks of holding one or more underperformed companies. When it comes to underperforming companies, that is the risk we have to take when investing. Every investment has its own risks. Same for SCHD. In 2023, SCHD did not perform very well because the Federal Reserve started reducing money supply to the market. With less money available, it is reasonable for the stock market to plummet. Some investors may also start selling stocks when they see the market fluctuate. However, the fund is still a solid choice for investors seeking passive income. In the long run, SCHD has shown positive growth. As we can see, the stock price appreciation is 112.84% in the past 10 years. So, each year the fund appreciates 7.77% on average. The current dividend yield is 3.34%, and the dividend growth rate is 10.87% every year. If you invest $100,000, your investment would become $267,551, with an annual dividend of $11,762. After 20 years, the investment would grow to $894,817. Now the annual dividend is $53,382. In the 30-year mark, the investment would become $3,507,988. Now the annual dividend is a massive $283,992. On average, you would receive $23,666 each month. The growth in both investment and dividend demonstrates the power of compounding over time. SCHD offers very good returns, but the next two are more favorable for investors looking for high growth. Now, let's check out the second ETF, Invesco QQQ Trust, ticker symbol QQQ. Unlike SCHD sets up strict criteria for picking the right stocks for the portfolio, QQQ simply tracks the performance of NASDAQ 100. This index represents 100 largest and most actively traded companies. The fund mainly invests in technology, communication, and consumer cyclical. Among all, technology comprises 50.36% of the portfolio. Development in the tech industry would impact the fund a lot. The largest holding for SCHD is financials, so QQQ is actually a good complementary of SCHD. When it comes to the expense ratio, QQQ charges 0.2%. It seems like this is 3 times of what SCHD charges, but it will make sense to you when you see the historical performance later. In the top 10 holdings, Costco is the only company not classified as a tech company. The rest are all well-known tech giants such as Microsoft, Apple, Nvidia, and Amazon. They are the industrial leaders in their respective fields and highly innovative, offering high upside potential in the foreseeable future. QQQ also includes high-performing stocks in consumer defensive, healthcare, and industrials, giving investors with exposure in other relatively constant-performing sectors. Currently, QQQ has a dividend yield of 0.54% and the dividend growth rate of 9.93% per year in the past 10 years. Impressively, the fund has grown 402.89% in the past 10 years. On average, the share price appreciation is 17.53% every year. This beats the S&P 500's growth rate of 11.02% per year. For a $100,000 investment, your fund would grow to $441,245 in 10 years, with an annual dividend of $1,170. 20 years later, the investment would grow to $2,255,297. At this point, the annual dividend is $2,712. In the 30-year mark, the portfolio would become $11,425,752. Now the annual dividend is $6,234. This is equivalent to $520 per month. As we can see from here, not a really big dividend, but amazing growth. The objective of this ETF is growth, so it makes sense to have a smaller dividend. The great performance resulted in the asset under management of $268 billion, and the fund became the second most traded ETF in the US. Now the question is, how risky is QQQ? Let's take a look at the standard deviation. Generally speaking, the higher the value, the riskier the ETF. For QQQ, the standard deviation is 17.33, which is not significantly higher than 14.92 for the S&P 500. But the return is much better than the S&P 500. According to Wall Street analysts, most of them are having a positive attitude toward the growth of QQQ, so a moderate buy rating is given to the ETF. The current share price is high, so we don't have to buy it at once. We can use a method called dollar cost averaging, where you regularly invest a fixed amount regardless of the price. When the price is high, you buy fewer shares, or you can buy more shares with the same amount of money when the price is low. If there is a market correction or crash, invest more money into it because this is a huge discount for us, like Black Friday. SCHD focuses on both dividends and capital gains, whereas QQQ tracks capital gains by outperforming the market. How about the third ETF? Can it beat the first two? Let's find out. The third ETF here is Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. This ETF is a growth focus. Over 99% of the fund is invested in the technology sector. The rest of the sectors like industrials, financials, and communication are under 1%. In the past decade, technology has been one of the fastest growing sectors. Currently, the fund owns 305 stocks. The top 10 holdings are taking 59.54% of the portfolio. So, FTEC had an amazing 472.56% in share price appreciation over the past 10 years. As a sector ETF, the fund offers investors exposure to a broad group of companies in the technology sector. Microsoft, Apple, Nvidia, and Broadcom are the top holdings. Inside the sector, we can further break down semiconductors, system software, electronic components, and so on. All of them are sub-industries of technology. Impressively, the expense ratio is 0.08%. It is very affordable compared to the growth. Is FTEC very risky? According to Seeking Alpha, the standard deviation is 19.73, which is slightly higher than QQQ's 17.33. So we can see FTEC is a little riskier than QQQ, but not so much. This also makes sense because FTEC solely focuses on the tech sector, whereas QQQ is more diversified. Like QQQ, Wall Street analysts are also given a moderate buy rating as recommendation, so we should have a cautiously optimistic attitude toward FTEC. In the long run, it still has great upside potential, but there are certainly fluctuations. The current dividend yield is 0.7%. Not very impressive, but it has a strong dividend growth rate of 13.77% in the past 10 years. The share price appreciation is at an outstanding rate of 18.95%. In 10 years, the investment would be $497,741 with an annual dividend of $2,159. In 20 years, this investment would grow to $2,905,625. Now the annual dividend is $7,403. Fast forward to 30 years, the investment would be $16,760,461 with an awesome annual dividend of $25,089. Investing in any one of these ETFs may not be the best of your interest. It is a good idea to diversify your investment, spread out the risks, and maximize the return. Tech sector is good, but it is very risky to place all capital in one fund. FTEC mainly invests in advanced technology, while QQQ provides the potential growth of the tech sector. SCHD balances both growth and dividend. What if we invest $100,000 in these three funds? We would have an average dividend yield of 1.53%, an average dividend growth rate of 11.52%, and an average share price appreciation of 14.75%. In 10 years, the investment would be $383,152 with an annual dividend of $4,362. In 20 years, this investment would grow to $1,652,248. Now the annual dividend is $13,547. Push further to 30 years, the investment would be $6,956,752 with an awesome annual dividend of $41,075. This is equivalent to $3,423 per month. Investing in SCHD, QQQ, and FTEC have the potential to yield the best result with minimum risks. With all three funds in one portfolio, your investment is well diversified. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.